the obvious thought would be something like infrastructure. And the reason why is because if you imagine a zero interest rate environment for a decade, any company that can grow its earnings will move to a premium, because everybody's going to be looking for some sort of growth, and it's growth in share price. It's a reliable income. It will allow you to pay a reliable income, and no one's paying any income out. So what people want is safe income. Infrastructure is the obvious sector to fit the bill, because they also have things like pricing power. You don't really know when you drive through that gate on the Tullamarine Freeway that Transurban's put its price up a little bit. No one will have pricing power in a zero inflation environment. So the companies that do will move to a premium, anyone that can grow. So the infrastructure sector is steady, often legislated or regulated growth, and they all have a return on equities on very large assets of sort of 6 to 7%, and that is very attractive. Particularly, you might have noticed Canadian pension funds bidding for Asciano, Japan Post bid for Toll, perhaps a little bit different, but they're basically buying reliable earnings. And because of that, the sector is likely to perform. The problem with that is the sector's already performed. And we used to have this rather boring sector sitting on a decent yield of sort of 6-7%, including franking. They're now 3-4% yields, including franking. They've got themselves, you can't necessarily say overpriced, but they've got themselves highly priced. And that may continue for quite a long time, or I don't think it will ever shatter, because the nature of the businesses is that they will never surprise you. So I don't think the share price will ever shatter, but there could come a period of time where they just stagnate. So if it's not infrastructure, you are going to, in an environment where not every stock is growing, where not every company can find growth, you're going to have to find companies that are growing. I think one of the sectors that will continue to sparkle and amaze is going to be the Chinese-facing companies. We haven't even scratched the surface of what Australia's relationship with China will look like. Take it 50 years down the track, and you'll probably find that there are dual-listed Australian companies, particularly in the financial sector, where the Chinese have a trust of Australia, which they don't necessarily have a trust of other Western countries, especially not if their president is somewhat unreliable, but they do trust Australia, and I think at some point we will make, or some points we will make product breakthroughs in things like financial services. You know, the Bellamy's and the Blackmores are small businesses that happen to have just touched on China and exploded themselves because they were so small, but at some point it'll go mainstream, and that'll be a very interesting investment proposition, seeing who is developing there. So we're going to continue to keep our eye on that, keep trying to time the stocks that are exposed to it. I'm fairly sure stocks like Bellamy's will, go again, and we'll try and make money out of that. And I think that's what you have to do. You have to find stocks, individual stocks that are going up, because relying on the market to go up is probably so 1990s.